Welcome to Tax Breaks. I'm your host, Kelly Phillips Erb. I'm a senior writer for Forbes, and you might have seen me on the web as Tax Girl. I'm also a tax attorney, and I work with tax professionals and taxpayers like you every day. There's a lot to talk about, so let's get started. This week, adventures in Alaska, budget moves, beneficial ownership information, or BOI reporting, a new IRS Commissioner, penny stocks and Roth IRAs, tax trivia, and more. You may notice that my backdrop looks a little different this week. I'm back home. As predicted, Alaska proved to be an adventure. While I wasn't chased by a bear, I did experience a few bumpy flights, was grounded by a blizzard, skipped across the frozen tundra in a snowmobile, and maneuvered around a SWAT team at my hotel. Yes, really. I also did a lot of taxes. Our team of trained tax preparers, we also happen to be tax attorneys, traveled to 4 villages on the northern slope of Alaska, including the longest continually inhabited area and the northernmost community in North America. Each morning, we would set up and wait for our first customers. In the larger villages, we could rely on radio to get the word out. In the smaller villages, we relied on Facebook posts and VHF radios. VHF radios are used in many rural Alaskan villages, and almost everyone has one in their home. The villages use them to share all kinds of announcements, from community emergencies to alerting the community that free tax preparation is available. It's also used, as we learned firsthand, to announce school closures during a blizzard, followed by a flurry of children calling to confirm that school was actually closed. As I noted on LinkedIn, I'm trying to wrap my head around my whirlwind week of working with underserved communities in rural Alaska. I learned a great deal about tax, legal, and practical challenges that taxpayers face, from tricky tax concepts to an unreliable postal system, and why it matters for all taxpayers, not just those in Alaska. I wrote a bit about my trip, and you can find a link to the story and some photos in the show notes. I was still in Alaska when I heard the news that U.S. businesses no longer have to comply with the Beneficial Ownership Information, or BOI, reporting filing requirements of the Corporate Transparency Act, or CTA. The dramatic policy change was first announced on social media by the Treasury Department. In a March 3 posting on its website, the Treasury stated that it would not enforce any penalties or fines associated with the BOI reporting rules under the existing regulatory deadlines, and that it would not enforce any penalties or fines against U.S. citizens or domestic reporting companies or their beneficial owners after the forthcoming rule changes take effect either. According to the Treasury, the new rules it will be proposing will narrow the scope of required reporting to foreign companies only. Though it's not completely clear whether, in this context, it will apply to foreign companies registered in the U.S. or to U.S. companies owned by foreign persons and entities. Before the announcement, reporting requirements applied to businesses created in the U.S. and foreign companies registered to do business in any U.S. state or Indian tribe. The surprise announcement has left businesses with unanswered questions, including what will happen to the data that's already been collected. It's also unclear what will happen to cases currently pending in court. Remember, cases are still winding through at least 4 federal appellate courts. It's also likely that additional lawsuits will be filed to force the administration to comply with the law. Importantly, the law is still on the books. And despite Treasury's assertions, the executive branch cannot simply overturn laws passed by Congress. It can, however, choose to not aggressively enforce a law, as previous administrations have done with cannabis. This can lead to complications since a future administration could opt into enforcement. Again, see cannabis. Also making news, the House of Representatives passed a major budget plan. The bill was passed on February 25, 2025, with a narrow 217 to 215 vote. Among other things, the bill calls for $450 billion in tax cuts every year from 2025 to 2034, adding up to $4.5 trillion over 10 years. The result is the projected U.S. national debt will rise from $35.46 trillion on October 1, 2024, to 55.57 trillion by September 30th, 2034, a total increase of about $20 trillion. The package also includes a $4 trillion increase in the national debt limit. The bill aims to cut spending by $2 trillion. If Congress cannot find $2 trillion in spending cuts, tax cuts will be reduced dollar for dollar to make up for the shortfall. The central focus of tax policy changes is an extension of the 2017 Tax Cuts and Jobs Act, or TCJA. If Congress doesn't act, some TCJA provisions are set to expire at the end of 2025. The result would include a rise in marginal tax rates for individuals, a decrease in the standard deduction for individuals, a reduction in the child tax credit, and, key for business owners, a loss of the pass-through income deduction. According to the most recent filing statistics from the IRS, over 4 million small businesses, or about 60% of all businesses in the U.S., are taxed as S corporations. Those are pass-throughs. The TCJA currently allows those and other pass-through businesses to claim a deduction equal to 20% of qualified business income. If the provision expires, the deduction will disappear. Also in budget news, a recently leaked memorandum revealed potential tax reform under discussion in the House that could reshape the tax obligations of U.S. persons living abroad and multinational business owners. Aside from the elimination of the U.S. estate tax, or death tax, the memo suggests a reduction in U.S. taxes for those working overseas on their foreign earned income and a lowering of the corporate income tax rate. These proposals could have far-reaching implications for individuals and businesses navigating the complexities of the U.S. tax system. House Republicans hope to have a final bill on President Trump's desk by May of 2025. With all of the uncertainty surrounding the budget and the IRS, taxpayers still aren't rushing to file their taxes. IRS data from the fourth week of the tax filing season, that's the week ending February 21st, 2025, continues to suggest that taxpayers are not excited about filing this tax season. Tax filing statistics are down in almost every area except for tax refunds. The IRS has apparently given up on excuses. For weeks, it offered an explanation for the lower numbers, stating that the agency, quote, expects the tax return filing numbers will level out in future weeks as the April filing deadline approaches, end quote. But the IRS didn't offer any such platitudes this go-round, just the numbers. The IRS received 42,707,000 individual income tax returns so far in 2025, compared to 44,584,000 in 2024. That's a drop of slightly less than 2 million returns, representing about 4.2% fewer returns. And part of a bigger problem. There has not been a single week in the filing season to date with an uptick in numbers. There is a bright spot. After a recent dip, average tax refunds have bounced back. The IRS issued 29,615,000 tax refunds so far in 2025, compared to 28,945,000 in 2024. That's an increase of about 2.3%. Speaking of bright spots, I appreciated how many of you checked in and offered words of encouragement while I was in Alaska. Some days, like when our flight was grounded, those were the things that kept me going. I'm also honored that so many of you messaged me to say that it inspired you to do some volunteer work of your own. That's honestly the very best thing that could have come out of my trip. No matter where you are in the world, I would encourage you to do two things. Number one, step outside your comfort zone. And number two, make a difference. And if you're really lucky, you'll have the opportunity to do both at the same time. Now, let's answer a taxpayer question. This week, a reader asked, with the markets going up and down so much, I'm seeing a lot of hot tips to invest in penny stocks. Is this a good idea for my Roth IRA? Here's my answer. Penny stocks, also called microcap stocks, are exactly what they sound like, cheap stocks. Despite the penny characterization, they are typically stocks trading below $5 per share. The upside of penny stocks is that they won't cost you a lot of money. If they go up, that's a win. If they go down, if you didn't invest too heavily, you're not out much money. Traditionally, however, penny stocks are pretty risky. They're often hard to research. It's easier to look into large, publicly traded companies on major exchanges. They may not be easily transferable for the same reason. Fewer shares changing hands in the market means less opportunity to offload them when you're ready. That volatility makes penny stocks a bad idea for a Roth IRA. A Roth IRA is a tax-favored individual retirement account, or IRA. With the Roth IRA, you pay the tax upfront on your retirement contributions in exchange for tax-free growth and withdrawals. Some restrictions apply. There are also no required minimum distributions or RMDs, and you can put money in your account for as many years as you're working, subject to some income limitations. Tax-free growth is a real bonus, but it does have a downside. You can't deduct losses inside a Roth IRA to offset regular capital gains or other income outside of the Roth IRA. That means that ideal investments are those that favor long-term growth and, importantly, are not likely to decrease in value. Investments that are high risk, like penny stocks, are not ideal. If you have a tax question or matter that you think we should cover in the next episode, let us know. You'll find more information in the show notes. Of course, if you follow me on Forbes, you know I love looking at statistics and enjoy a good chart, map, or table. This week, I'm focusing on IRS commissioners. The IRS is on its third commissioner in just over a month. Secretary of the Treasury Scott Bessent announced that IRS Chief Operating Officer Melanie Krause will become acting IRS Commissioner following the retirement announcement of Doug O'Donnell. O'Donnell had served as acting commissioner following former IRS Commissioner Daniel Werfel's departure on January 20th, 2025, 1 week before the tax season officially kicked off. His departure, meaning O'Donnell's departure, on February 28th, marks a remarkable 39-day span of rotating commissioners. Until now, Robert E. Hannigan had served the shortest term, weighing in at 3 months and 14 days in 1943. His predecessor, Guy T. Helbering, served the longest term, reaching 10 years and 4 months. You can find a list of the commissioners from the last 50 years by term in the show notes. Commissioners are nominated by the President and confirmed by the Senate. The IRS Commissioner and the IRS Chief Counsel are the only political appointees in the agency. IRS Commissioners typically serve a 5-year term from the date of their nominations. That's set by the IRS Restructuring and Reform Act of 1998, which means that Werfel was expected to leave in 2027. However, breaking with tradition, Trump announced that he would replace Werfel with his own candidate for the job, Billy Long. Following Werfel's departure in late January, Deputy Commissioner Douglas O'Donnell stepped in as acting commissioner. O'Donnell has served as Deputy Commissioner since early 2024, but served as acting commissioner for just under a month. Last week, he announced plans to retire. IRS Chief Operating Officer Melanie Krause will now serve as the acting commissioner. Krause has served as the IRS Chief Operating Officer since last year. A relative newcomer to the agency, Krause joined the IRS in October 2021 as the Chief Data and Analytics Officer. In this role, in addition to leading the Research, Applied Analytics and Statistics, or RAAS team, Krause coordinated research activities, including AI and other advanced analytics. Krause also served as Acting Deputy Commissioner for Services and Enforcement from November 2022 to March 2023. Now it's time for a little tax trivia. Alaska is one of 5 states, Alaska, Delaware, Montana, New Hampshire, and Oregon, that does not have a state sales tax. Which of the states with a state sales tax was the first to adopt one? Your choices are A, Kentucky, B, Mississippi, C, North Carolina, D, South Carolina. I'll give you a minute. The answer is B, Mississippi. Mississippi adopted a state sales tax in 1930 in response to a budget crunch created by the Great Depression. By the end of the 1930s, 22 states had implemented a state sales tax, including North Carolina in 1933. South Carolina added a state sales tax in 1951, while Kentucky didn't sign on until 1960. Now it's time for a deeper dive, and it's a look at the business meals and entertainment deduction. I always tell taxpayers to keep excellent records. Sometimes, though, keeping track of the receipts is the easy part. Figuring out what's actually deductible can be much more difficult. That's especially true when it comes to the entertainment and meals tax deduction, which has changed a few times over the years. Currently, the limits on business meals and entertainment are as follows. That food at your company holiday parties, it's fully deductible, as are food and beverages given to the public and dinner for employees working late at the office. Business meals with clients, food items for the office like coffee, and meals while traveling for work or at a conference are only 50% deductible. Most business owners focus on those business meals, which are only 50% deductible. If you're scratching your head because you thought they were fully deductible, that's because special COVID relief-related rules in 2021 and 2022 allowed for 100% deductibility, but those rules no longer apply. Under current rules, if you take your favorite client to dinner, to discuss business, of course, you can only deduct half the expense of the meal. You'll want to keep a record of your deductible meal, including the date, total cost, including tax and tip, name of the restaurant, and details of the business meal, including who attended and how it related to your business. An easy way to track? Jot those details on the back of the receipt. You don't have to write a tome, just a few notes reminding you who was present and what you talked about. Like, Paul Rudd, we discussed tax planning opportunities related to the role in the next Ant-Man movie. If in doubt about whether a meal or entertainment expense might be deductible, ask your tax professional. And now for something a little more brief. Quick tax and accounting newsmakers. The IRS has announced interest rates will remain the same for the calendar quarter beginning April 1st, 2025. For individuals, the rate for overpayments, yes, the IRS does have to pay you interest sometimes, and for underpayments will be 7% per year compounded daily. The rate is 6% for corporate overpayments, or 4.5% for the portion of the corporate overpayment exceeding $10,000, and 7% for corporate underpayments, bumping up to 9% for large corporate underpayments. Also, my team isn't the only team preparing tax returns for free this year. Cherokee Nation citizen James Jim Muskrat, a 98-year-old CPA and Army veteran, will prepare taxes for free again this year in Joplin, Missouri. Muskrat has volunteered for the VITA program since 2013. Arkansas has proposed legislation to repeal the state's grocery tax. The Grocery Tax Relief Act would not impact county and municipal grocery taxes. The loss in revenue from the elimination of the tax would impact the Arkansas Game and Fish Commission, Arkansas State Parks, Arkansas Heritage Commission, and the Keep Arkansas Beautiful Commission. And in international news, the Swiss government has opened the consultation process on a new Foreign Account Tax Compliance Act, or FATCA, agreement to provide for the automatic and reciprocal exchange of information between Swiss and U.S. tax authorities. Under current law, Swiss financial institutions disclose account details directly to U.S. tax authority with the consent of the U.S. tax clients. When U.S. clients do not consent, the U.S. requests the information through administrative channels. There was a huge change when it happened about 10 years ago, but under the old agreement, no account data was transmitted from the U.S. to Switzerland. That will change in the future. Switzerland will now also receive account data from the U.S. And that's a wrap. Thanks to all of you who continue to watch, comment, and share the show. I'd love to know what you thought of this episode. You can send an email with your feedback to kerb@forbes.com. And if you liked it, please share. You can find a link to the audio of each episode on Forbes.com. Thanks for listening, because paying taxes is painful, but hearing about them shouldn't have to be.